My name is Taimur Beg. I'm Chief Economist at DBS Group Research, and it's great to have you. Let me begin by telling you what we will not talk about. We will not talk about Bitcoin's amazing performance this year. You can ask us questions. There will be a QR code, and if you want us to talk about Bitcoin, we will later on, but not in this core of the presentation. We also will not talk about equity markets per se. We do have certain views on China equities and certain sectoral things in ASEAN and elsewhere. Again, if you have questions, feel free to ask them through the Pigeonhole, and we'll take on questions on crypto equities if you want. But by and large, this will be a lineup of macroeconomists giving you macro presentations. So I will kick it off and spend about 8 minutes talking about our broad global overview. And then I'll have the pleasure of giving the floor to our brand new addition to the team, Moji, who's just flown in from Hong Kong. She's our China chief economist. And then you see we have senior rate strategist Philip Wee and senior FX strategist Philip Wee and senior rate strategist Eugene Liao, who I'm sure many of you know over the years. They will go over currencies and rates. Han Teng Chua, our first full year completion of covering Singapore. He'll talk about Singapore. Ma Ting is here. She'll talk about Taiwan. Radhika Rao, dual hats between India and Indonesia. And then Chang Will-young, who does very good work on credit and also on certain products that we have on the FX side. He'll talk about his side of the story. So let's get going. That's the QR code. If you have any questions or if you want to upvote or downvote the questions that have already been asked, feel free to scan it. And this is not the only opportunity you will get. Through the course of the presentation, we will feature that QR code. So I would sort of urge you not to raise your hands for the next hour or so. Put in all your questions. We will go through them and we'll put them up in the screen and keep the flow going that way. All right. So yeah, you don't have to scan. You can just type dbs.pigeonhole.at and use the password macro. The green dots on the screen are countries that will have a better 24, and the red dots are the countries that will have a slightly weaker 24. So horizontal axis, growth in 23, vertical axis, growth in 24. It's interesting, sometimes, arithmetic doesn't tell you the entire story, because the countries that are on the green side are not just because they're on the green side because they have an amazing outlook for 24. It's partly because they had a pretty ordinary 2023. Classic example would be Singapore, which has less than 1% GDP growth in the making for 23, driven by very weak exports. But thanks to the base effect, thanks to some degree of reopening and expected pickup in exports, we think Singapore will grow by over 2% next year. Han Teng will elaborate on that later. Taiwan, similar story, very bad 2030, presumably going to be a better 24 around better electronics exports. Tian will talk about that. Similarly, again, Malaysia, Vietnam. What is common among these countries? They're all heavily exports dependent. And 23 was a really bad year for exporters. We're hoping as we end 23, go into 24, things will get better. Now, on the bottom side of the spectrum, countries who will have a weaker 24 compared to 23, this is where, arithmetic telling you partial stories, not complete stories. India, as we all know, is red hot, but it's kind of below the 45-degree line. Doesn't really mean anything. It's growing close to 7% right now. It'll grow close to 6% or maybe even higher next year. So it has a lot of good things going for it. Just because it's below the 45-degree line doesn't tell you everything. Big question is China. Moji will talk about that. China, we think, will slow a tad next year. So 5-ish this year, 4.5 next year. Lots of risks around that forecast. You'll hear more from her on that one. The country that remains on the underwhelming side would be Hong Kong. They don't need high interest rates, but because they have tied their fortune to the US dollar and US interest rates, they've gotten a lot of counter-cyclical pressure this year when they didn't really need any of that stuff. The US right now is rocking. Even in the fourth quarter, we think growth will be over 2%. Probably will end 2023 with over 2.5%, around 2.5% growth. But we do think that there is something called gravity in life. When you keep rates high for a while, it does slow things down. And we will see that. I'll talk about that in a slightly greater detail later. So we think that there is no recession in store for the US or Japan or Eurozone or anybody in 2024, but they will slow under the burden of high interest rates. And the big question mark is, of course, around China. On inflation, you got to reverse the colors, right? Because you can't say next year somebody who has higher inflation is green. So Now, if you're above the 45-degree line, you're red. If you're below, you're green. Your inflation outlook for next year is better. And by and large, I don't think we need to worry too much about inflation right now. There are many risks around the edges. We will talk about them in later. But by and large, right now, in December 2023, the way oil price, food price, services prices are going, it seems like the worst of the inflation nightmare of 2022 is not coming to revisit us anytime in 24. There's always a risk that we might get that wrong, but by and large, central scenario is a rather benign outcome. Most countries that we follow will have a lower inflation rate next year than this year, and even the ones that we think will have slightly higher inflation rate next year than this year. It's very much on the margin, not a big deal at all. Okay, I want to sort of abruptly move a little bit because we just spent 2 slides talking about growth and inflation outlook, but we need to talk about the money. Where is all the money in the world going right now, given the high interest rates in the US, given the lackluster outlook in China, and also a lot of uncertainty about US Treasury market, massive issuance, can it be sustained, will the bond market fall apart? So that sort of stuff. So what are investors doing? Investors, of course, parking a lot of their money in money market funds. I've done that. I'm sure most of you have done that. Why not, right? 4-5% yield in US dollar terms, 3-4% yield in Sing dollar terms. So very juicy, and banks like us have felt that pressure, that, from short-term accounts, from checking accounts, money moving into deposits, fixed deposits, and so on. So you could call that dry powder, that if rates come down, but rates come down and the markets gets cheerful because monetary policy tightening is over, there is a lot of dry powder out there to be deployed into equity markets and other assets. So that's one way of looking at the fact that the search for high interest rates have manifested into spikes in money market funds, but that money can readily come back into financial markets if the global economic trajectory turns out well. But then there's the treasury market, where we've seen a pretty spectacular rally in the last 4 weeks or so. Yields were like 5%. They're down to 4.2% of the 10-year rate. Still pretty high. And it's a very good question, who buys U.S. Treasuries when geopolitically, it's not that straightforward to hold U.S. Treasuries. There's weaponization of dollar. If you're China, your external surplus has come down. Maybe you're not that much into it. You want to make the RMB more acceptable. So maybe you don't want to buy too many treasuries. Maybe you worry about the war risks around Ukraine, et cetera. So if you're Russia, you buy gold, not US treasuries. So what's happening? Look at the gray line. Official foreign holders of treasuries, kind of flat. So nobody's really buying on the official central bank side. Look at the Fed. Definitely not the big buyer anymore. Quantitative tightening and slowly its holding of US treasuries coming down. So who is buying? Private sector. First of all, US private investors can't get enough of US treasuries. They're buying them in very large numbers, but even non-US private sector, significant pickup in demand, because again, nobody seriously thinks the US would ever default. Nobody seriously thinks that US is about to let fiscal go completely out of control and there'll be runaway inflation, and even at 5% or 4%, US bonds will be loss-making. People don't think that seriously. Whereas you have a lot of insurance companies, pension funds, high net worth individuals who would love to get a 10, 20, 30-year paper, which is rated AAA and yields 4 or 5%. Why wouldn't they? Hence, despite bad fiscal behavior, government shutdown-related drama, U.S. still is very well bid, the U.S. Treasuries. By contrast, nobody likes emerging markets. So I've taken these 2 slides from IIF, and when you look at what has happened with respect to flows into emerging markets, it's just a bad sort of outcome all through 2023. We have seen some inflow into CGB, Chinese government debt, but beyond that, emerging markets got no love in 2023. And when you look at net capital inflows, as you can see, that black line, it's been negative through most of this year. So 23 was, despite, hot U.S. economy, despite very large deficit, despite very large debt, we had no shortage of bid for U.S. Treasuries. But as far as the emerging market was concerned, the strong U.S. dollar, the pull from U.S. rates, which is a tough 23 for everybody, there was not much flow into it. Now, I want to make one point regarding India in this respect. India's capital markets have performed tremendously well in 2023. But when we're looking at international flows, it seems like nobody in emerging markets got much flows. So how come India did so well? this is where the importance of domestic sentiment comes in. In a country like India, domestic investors are super optimistic about the future. They don't need foreign inflows. They have a current account that needs to be financed, but by and large, Indian equity market, Indian debt market are being bid by Indians. Indian mutual funds, Indian retail investors, and this is the biggest contrast between India and China right now. We have lots of constructive things to say about China. You'll hear from Mo. But we cannot deny the fact that confidence is very poor in China. The Chinese themselves don't have much confidence in the stock market, in the credit market. Indians are exactly the opposite. They feel their time is now. And it's kind of amazing. Just that confidence itself can become such a big self-fulfilling prophecy for fundraising, capital raising, and so on. All right. I'm going to go through 3 scenarios now. Okay? As you know, our title of our annual outlook is that right there, soft landing with a question mark. I think the way things are panning out right now, I think we need to remove the question mark. I think we're kind of slated for soft landing. I call this like a 60% or maybe even a little higher than that scenario. So what is a soft landing scenario? We're seeing gradual softening of the US jobs market. We're seeing manufacturing and services PMI in the US ISM survey shows they're coming down a bit. Not a collapse, not very bad, but the high interest rates are beginning to have some impact on activity. So we think gradual slowing of US labor market, some softening of growth in EU, which is already sub 1%, ordinary outturn in China, but no financial market accident. We don't need what happened with SVB, or we definitely don't need what's happened with structured products back in 2008. We don't need any of that. If no financial accident and this sort of things pan out, we have a soft landing scenario. But there's also a possibility there's no landing whatsoever. I mean, again, just look at the data flow out of the US. Some gradual slowdown here and there, but look at the housing market. Despite extremely high mortgage rates, we've had a bottoming out of home prices. In fact, look at this chart. Home prices never went into negative territory through this entire cycle. Yes, it was not growing in early 23, but never, the prices never fell during this cycle, despite rates going from 2.5% mortgage to 8% mortgage. People never really give up because there's a huge shortage of home supply in the US. And similarly, on the inventory side, for a while, the market stopped functioning because people were scared of the rates going up, but now it's come down a bit, little zigzag around there. But by and large, the US housing market, which is a very large chunk of the US economy, just like the Chinese housing market is a very large chunk of the Chinese economy, if that is functioning, I'm not really sure whether we're going to have the sort of landing that I'm featuring in my baseline scenario. Then look at US equity markets. Case-Shiller PE, we have a PE of over 30. And this is not a sign of a market that is slowing down under high interest rates or beginning to worry about accidents. In fact, the US market valuation is higher than it was before the global financial crisis. It's that expensive. And there's that much exuberance and optimism built into the US market. One can argue that it's a very narrow pickup in US markets. It's the Magnificent Seven stocks that are doing well. Others are not. But the fact of the matter is, when we look at what's happening in the US housing side and the US equity side, I really don't see much of an impact or sign of any landing whatsoever. So that's the no landing scenario. I'll talk a little bit about what that means for interest rates and stuff in the forthcoming slides. All right. Then there's a hard landing scenario. Nobody's thinking about this right now. Absolutely nobody. Everybody thinks that, look at this red line, the real interest rate about 2% in the US economy can move on. When we think about China, we think that, between stimulus measures and structural reform, things can go on. What if we are wrong on both counts? What if that 2% real rate manifests into massive downturn in the US economy next year on housing, on consumption, on people's debt services? What if China, which is showing signs of distress because rates keep coming down because the economy needs support, shows no sign of turning around? So I assign not a lot of probability to this scenario, but we got to keep in mind. And look at the risks we have listed over there. Inflation may be not going to be super easy the way we think it is. Maybe it gets a bit stubborn, particularly services sector inflation. Good side, I think we're okay, but services inflation. Rates remain high. The Fed basically tries to convince the markets they're not going to cut in 24, which is what the market is expecting right now. But let's say the Fed, under those scenarios, doesn't do it. And that, of course, creates some stress in US Treasury market, private markets, and so on. Geopolitical risks, always there. But then the last one. I added it, actually, recently. I think Philip Wee told me to add it. That don't stop, talking about the pandemic. It's not gone away at all. So thanks, Philip. I threw that in. And then 3 months from now, when we see some bad headline, you can, thank that guy over there. All right, so now let's just boil it all down. base case, bull case, bear case, or rather soft landing, no landing, and hard landing. Those are our probabilities associated with that. But the bottom line around that is that we think that the chance of the U.S. sort of keeping rates unchanged in the first half of 2024 is pretty high. So if you add 60 plus 20, we're basically saying 85% chance. And then there is some rate cut in the second half of 24. Basically, the market pricing. And around that, we see some growth slowing. Although in the case of China, the bull case would be that, structural reforms and property market restructuring, everything works out, and some animal spirits come back to China. It's woefully needed. It's been missing for 3.5 years. We can hope, right? But then there's this scenario, which we all hope will not happen, but could happen, which is stubborn inflation. The US federal authorities are compelled to hike even further in 24. And then, of course, we have huge sell-off in equity markets and debt markets, and huge likelihood of financial sector accidents and global sort of hard landing, significant decline in growth. And then we see in the case of China also, all the things that we think will turn around does not turn around, and as a result, we have sub 4% growth. So let's hope I'm completely wrong, and this 15% scenario is indeed 15%, 1 in 8, or something like that, and will not happen. But by and large, right now, we feel confident about the first two scenarios, and some of the presentations you'll see from my colleagues for the subsequent follow-ups would be sort of based around the first two scenarios. So I will stop right there. Thank you. Mo, mic is yours.
Thank you for coming. So I'm brand new to DBS, but may not new to some of you who have ever listened to my presentation before. So I'm going to talk about, for 2024 and beyond, what China is going to look like. So actually, China is building a new model now. The old model doesn't really work for China. Everybody is deeply worried about China's, growth, the future, etc., etc. So what the new model will be look like? I think there are 3 fundamental things for markets, for everybody here to think about. Number 1, certainly, is about the funding of growth. So the funding of growth, we know before, China is really debt leveraged. So debt leverage meaning, in the past, 10, 15 years after 2008 financial crisis, China has been doing all the deleveraging along the way. Now the thing is, China needs to change it to tax, financing. Even they say like equity financing, etc. Then the debt before is mainly loan, right? So the thing here is how the transition has been going. It has been going very, very slow. One example is about the property tax, as you know, right? It has been arguing for a long time, but it doesn't really fully implement it. The second one about China is about the pillar of growth. So the pillar of growth, we know when China enters the WTO, it's about, the export-led growth. It has been very successful, but later on, we know for the 11th five-year plan, that's a year in 2005 to 2010 at that time, China says we need to transfer into, consumption-led growth. But now you also see, for the consumption-led growth, here, you also see for China, in terms of the funding of growth. This is the, in terms of the, here, I will go back. Okay, so in terms of the, then from the export growth to the consumption growth, but it has been, plateau here. It's just like, 50 something and also going down. Consumption is experiencing a downgrading after the COVID situation. So then in my mind, going forward, for the next, 1 decade, 2 decades, China needs a pillar of growth of demand growth. So what's the demand-led growth? It has 2 parts. One part is about consumption. The other part is about investment. So China needs both consumption and investment. There's a lot of arguments and debates in China among policymakers, academics, and market participants. It's all about China shouldn't do investment because before it's the old traditional investment led. But China's investment can be green, right? We can do, R&D, we can do innovation. So this is something China should do. Now, the second thing, about, in terms of China, we also see China needs structural reform. We know China has done a lot of the structural reform, especially the first side is about the supply side reform. So it's about decapacity. We know in the steel industry, coal, etc., they have done, a lot over the past, 10 years. Then we see even for steel, the decapacity almost completed. So what's the next stage? So in terms of the next stage for China, most importantly, China has to do the demand side reform. So demand side reform is equally important for China Then what's demand side reform meaning for China? Most importantly, it's about the household disposable income. So the household disposable income, if you see in terms of the annual growth, is just at 7.2%. But Chinese households facing three mountains. So the first one certainly is always the property, the second one is healthcare, and the third one is education. But both of them are growing at a faster pace than the household disposable income. So this is why we see the demand side reform is imperative and is necessary. They have to do it as soon as possible. Then you may ask me, how can they do it? They have to create more jobs, right? The COVID lockdown has really prevented, not only creating the jobs they cannot create, but actually they have been reducing a lot of jobs. So next stage for them, they have a lot, to do for the current Chinese government. Then in 2024, you may ask me, what's the basic scenario for us? The base is we think in 2024, there will be soft landing, it's into our big, scenario. And also we think it will be soft rebounding, and also there are soft risks. So what does soft landing mean for China? So in the past 3 years, number one thing in China is all about property sector. So properties, the recovery is all into these three, basic, themes in what we are thinking about. So in terms of the soft landing, we think in the past 3 years, the very key elements for the current China's, deleveraging in the property sector is for the developers, but not for the household. So this is why the household sector, their leverage level is very stable. Not only stable, for all current policies, it's helping them not only stable, but also, they are re-leveraging up. So this is a very consistent policy for the Chinese government. You may ask me why. It's very clear. For the Chinese, policymakers, the number one thing in their mind is about stability. But on stability, they have social stability, they have economic stability, they have political stability. So they have to have economic stability to ensure political stability. But by the end of the day, the most important stability is the social stability. So this is why the housing, in terms of their leverage level, stable is so important and key to them. So currently, all the leveraging is happening with the developers. So this is why China is very different from all other countries in terms of the deleveraging cycle. So that's why we didn't call China's property deleveraging is a hard landing. We say it is a soft landing because it's only part of the sector is doing the deleveraging. Then for the soft rebounding in 2024, we think it is soft. It may be softer. It's not like, the economy will be normalized. Why it is that? It's also very simple. So for the property sector, for the developers to deleverage, it has a long aftermath effects. It will be crowding out, both consumption and investments. So this is why, for us, we need to think, if it crowding out, it doesn't take, only like, 2 to 3 years, it can be completed. Why? Because the housing sector is connected to over 300 sectors. So all this will be impacted. So this is why it takes much more longer time than market thinks it recover. Then the last thing is about the soft risks. Why we think in 2024 it has soft risks? China may mainly faces three risks. One is about the recovery, of the, the property sector. But most importantly, the risk is coming from the unfinished homes. So if you see, the unfinished homes here, it has the government, the corporates, and the developers. They need to spend all the money they can to try to help to solve these unfinished homes. Why? It's just at the beginning I've been saying, the social stability. Otherwise people will jump in, so they will commit suicide. It's all their money putting there. So this is why it's so important. But also it's about LGFVs. But for the LGFVs, I want to remind you here, for the local government debt, everybody's talking about it. They will restrain, for the local governments, tell governments to issue more bonds, etc., etc. But at this current stage for China, if they are putting any tighter policies on the economy, it will be very negative for the economy to recover because the economy itself needs actually a lot of liquidity. So we have done a box study. Our report was published last Friday. So if you need it, you can ask any of your people, who covers you. So the book study is talking about the liquidity in China. So in stock term, it's very abundant. So it's around 288 trillion in the whole system. It's very high. But in both flow and growth terms, China's liquidity is very light. What does it mean? It meaning China needs both monetary and fiscal, easing. Any kind of tighter policy at the current moment would not help the current economic recovery. So this is why, overall in 2024 will be soft landing, soft rebounding, but also soft risks. Then, for Hong Kong, we know Hong Kong has been experiencing very bad years in the past 3 years. Hong Kong's equity market, is so poorly, performed. We know like minus 20, minus 20, in consecutively. People lost confidence. Liquidity has been drained. But this is mainly driven, except all others, is about the US Fed rate, right? But Fed rate hike, as what Herman has been mentioning, is finally, pausing, peaking, and they may, need task to cut. So this is why Hong Kong now is positioned to be bottoming, to be, unfolding its, recovery, and, among all those uncertainties. So Hong Kong is poised to recover based on the current soft landing. It will recover, but it wouldn't recover as strong as market expect as well. So this is mainly our outlook. Thank you.
Thanks, Mo. Hi, I'm Philip. I'm going to take you through FX. As you can see, there are many presenters here, so we have to really go very fast. So, and apologies. But if you need to scan the QR code, here it is. Ask questions. I'm sure you have plenty. Okay, I'm going to start off. I'm going to talk to you about currencies. So for most of this year, ever since I started, so this is the framework. At the end of the day, I think, I'm sure anyone who traded FX this year will feel very frustrated. So it's been we have 3 up cycles in the dollar, and then we have 3 swings down as well. So it's been a very choppy year. But when we came into this year, we sort of laid the background and told everyone that you have to understand how things are going to evolve. This is still very much about inflation, still very much about central banks hiking. So you have to move with it. So last year, dollar was very strong. In fact, it became too strong one way. But the moment the Fed starts tilting towards a slower pace of hikes, so the too strong became, it started plunging sharply as well. So it sort of, tell you that it's going to be the fair value is somewhere between the highs and the lows that we saw, in the fourth quarter and the first quarter of this year. So, but when we came into this year, we know that at least on the supply side, the inflation, the worst is over. Headline CPI is coming down. Unfortunately, core is still very sticky. So, but central banks are already very relieved. So they're telling all of us, okay, look, I don't have to kill all of you with rate hikes, of 75 basis points. At one point, I was very worried, when I was doing seminars. People got used to the idea of interest rate going up by 75 basis. I told them, do you know 75 is the normal 25 times 3? So, and you're okay with that. I said, so we were quite relieved when they stopped after 475. And, so then they started going back to the kind of hike cycle that we have seen before the COVID. And that is, if you look at, let's say, the Fed pause in the last 2 quarters, so we've gone from 1 hike every meeting to 1 hike every quarter, and the hike size is 25. So, okay, but the problem is that when you come into this year, you see, when you look at the dollar, it's a dollar index. But dollar index is made up of a lot of other currencies: euro, sterling, Swiss, yen, Canadian dollar. So, so you're actually not dealing with just the dollar. So, and all these other countries are also fighting inflation. And they are also, sort of following what the Fed has done, which is why at the end of the day, the divergent story on monetary policy has become more convergent, which is why you get the kind of swings. So we think that this story will continue into early next year. But as time has shown, the first chart where we see a lot of the Asian countries having stronger growth. So, okay, my outlook for next year is very simple. Okay, let's hope, I'm really keeping my fingers and my toes crossed, that all central banks at one day, they're going to tell all of us that they are done. So, and when they're done, that means that there's no more interest rate policy to play because they will want to keep rates elevated. So, and during that period, we will start searching for relative value, and that's where I think the growth story will come in, and that's where I hope Asia, will get back what it lost this year. So next year, to me, I think the key word is normalization. Okay, so what it means to me is that interest rates has gone up a lot. What they need to normalize is, real interest rates, maybe just easing back a bit. So next year we have 100 basis of rate cuts in the second half of the year. Okay, so let me show you what's our forecast. A lot of numbers here, but don't worry, let me show you how to read this. Just take a ruler, okay, the top left-hand corner, draw a straight line to the bottom here. That's the trend. Okay, so the trend of the forecast is, okay, we are seeing it come off. That's the broad trend. Okay, this is what I call a 60% probability forecast. It is based on timers 60% probability of a soft landing. Okay, so all the assumptions are there. So we really need to have a soft landing, and we have the Fed cutting rates, and I'm beginning to feel a bit more comfortable about the outlook for exports. Our own central bank is also thinking that the second half of next year will look better. So, and of course, heaven forbid, let's not get another geopolitical shock. Okay, 2 years ago, we had Ukraine, Russia. And then this year, we have Israel, Hamas. So next year, okay, please, no Taiwan. Okay, and please, Philippines, and China, let's have no incident there. So a lot of things to worry about. But then again, when you look at the geopolitical risk, after the initial shock, what happened, right? All of us, life goes on. Okay, so we go back to the economics, etc., etc. Okay, in any case, in terms of the three scenarios that we have, hard landing, no landing. Low landing to me is the worst. That means I have to adjust this. No landing means that the Fed, may keep on hiking. I think our worst case is 6%, right? And no landing. Oh, that's hard landing, from 6%. Okay, so actually my preferred scenario is hard landing. Okay, so but since in this room only, please don't go out and repeat. Okay, because on FX side, I was like clear trends. So if we are hard landing, then we know that at the end of the day, policy will all respond in one direction. And then we know that when things get really bad, they will come and rescue, and we can turn back up just like COVID. So that is very clear. Okay, so at this point, it is pretty muddy. Okay, because the problem is that every day you talk about the Fed, but the reality is that it's actually a lot of central banks moving together. There's a lot of coordination in terms of trying to cool down this to declare victory on this inflation fight. Okay, I'm going to speed up a bit. Okay, so we have three big calls. I just gave you the main assumption. So Hunting, our Singapore economist, and Eugene, we've sort of decided that next year, if it's really normalization, all the central banks cut interest rates by 100 basis, then Singapore should also start to ease the policy. Okay, when I ease, I'm actually talking about normalizing. Currently, our slope is about 2.5%. Okay, so, and this year, we haven't had any policy changes. As you can see here, there are no red dots. So, but why do we need that? I mean, the exchange rate has been very stable along the middle and the upper half. So it's pretty well managed. So there's no real panic. So it's balancing quite well all the risks that we're seeing. So, but when it's time to move, we think that the slope will go from 2.5% to about 2%, and that will be consistent with the forecast of trend growth, which MTI is forecasting about 1 to 3%. Our central bank is thinking trend growth of 2 to 3%. Output gap will remain negative. But more importantly, the core inflation is also around the 2%. If you strip out the GST that's coming. Okay. So in dollar sing terms, I'm looking now at the 130 or 135 range. I don't, discount that if there's some kind of minor shocks, we could see the 137 again. But by and large, if our scenario play out, the bias should be, the pull, the gravitation, or the gravity should be for dollar sing to always think, lower. But I'm not prepared to put any forecast below 130 yet, okay? Because we have not seen that level below 130 since 2015, since the currency war. So, but on the other hand, let's not get greedy. Okay, at that kind of exchange rate, I think we can travel quite comfortably. So yeah. Okay, I'll speed up. Yeah. I love being up here. Okay, so, second big call is the Japanese yen. Okay, so this is dollar yen, so we're expecting dollar yen. We hope that we have seen the worst. 150, we've tried it twice, last year and this year. And, it'll come down. The big assumptions that we have, of course, very importantly, the Fed cut. But before the Fed cut, Japan is ready to normalize the interest rate policy. And finally, okay, so BOJ, our forecast is that they will end the zero interest rate policy in second quarter. And the interest rate differential will narrow, dollar yen will come down. And when dollar yen come down, this should help to guide the dollar Asia down as well, including the renminbi. Yes. Okay, so this is my last slide. This is a question that was pop up. What do you think will happen to the dollar during the US presidential election? Okay, so this is the percentage sort of changes. I only start from 1972 after the end of Bretton Woods because all periods before that is fixed exchange rate. Okay, so as you can see in the early years, most presidents during the election year, they want the dollar to be strong, right? To tell their voters that I've done a good job. Okay, please re-elect me, or please replace me, or replace the other president with me. So that is, I think one reason why it tends to be strong. But unfortunately, the last few years, world has become more complicated. So you find that you can start out strong, end up weak, or start out weak, end up strong. And in the last election that Trump lost to Biden, so it was sort of, we ended up, weak. So it's very hard to make a call. Okay, so if I have to select, I've already gone through every election, and the one that's closest to Biden's is really Obama and Clinton's, as you can see here. So it sort of suggests that, the dollar can continue to go up. Okay, so I don't think we will be anything near Reagan. Okay, Reagan was when US was fighting inflation, but with very, very high interest rates. Okay, interest rate hit 20%. Okay, who can fight 20%, right? So, but today, the interest rates, US and a lot of the G7, the gap isn't that wide. So, it's more benign. Okay, so this to me could be, if this materializes, then I will be paying more attention to no lending risk. Okay, so that's my presentation. I'm going to pass to Eugene. Okay, thank you.
Okay, thanks very much, Philip. So for my section, I'll just be focusing on rates, which has captured a lot of attention over the past 2 years or so. The way I see rates, again, is quite similar to how Philip and how Timer views, which is look at the evolution of the different aspects of the economy, markets, policymakers. Right. So we kicked off last year with very aggressive hikes. And when we made the call that the Fed is ready to pause back in July, it was not clear. In fact, many other people thought that there would be further hikes coming in. But we held on to it, and so far it has worked out quite well. And from the signals that's coming from the Fed, it looks like they are about to pause. So that is a big shift, right? And then the other thing that we are looking out for is that can the economy handle these very high rates, right? And I think the big surprise to many market participants is that despite 525 basis points of hikes, we see an economy that has been tremendously resilient, right? There's been talks about recession all the way from late last year all the way to now. But in spite of all the little crises that broke out, nothing seemed to really derail the US economy. But if you look at the data, you have the unemployment rate below 4% from last year to this year, despite so many hikes. And you have a more benign situation where CPI comes off from 9% to 3%. So I think things are aligning towards like a soft landing, like what Timer mentioned. It is also what we have been promoting for some time, which is Goldilocks. Things are not so hot and not too cold, and it has been supportive of risk assets. So this is where we are now. We have finally hit the point where the Fed and many other central banks are pausing. Where do we go from here, right, as we head into 2024? So the other thing that people keep talking about is rate cuts. Again, rate cut speculation has been around since late last year, but they have been wrong again and again. So where do we see this, right? So we see it in the second half of this year. So around mid of this year, I think there would be case for cuts, and we have 100 basis points for 24 and 100 basis points for 25. Right, so cuts will come, may not be that soon. I don't think it is imminent. And then it would need to be accompanied by clearer signs of a slowdown. Right, inflation that above 3% does not cut it. We'll need inflation sustainably below 3 for a few months. And unemployment of below 4% again will not cut it. We probably need unemployment rate of closer to 4.5%. Right, so we haven't quite hit the point where the Fed needs to cut. What does it mean for the markets, right? So 75 basis points of hikes are very rough for the markets, right? Dense sentiment. So over here, I have a gray line which shows sentiment. So if it's high, it means that stocks are doing well, credit spreads are tight. Now, if it's on the low side, it means that sentiment is weak. And you put that across with Fed hike. So the bars, you see there's been a spike around last year when there was 75 basis points being delivered at each meeting. So when the Fed was pushing and trying to strangle the economy, slow it down, stocks don't do very well, right? Sentiment is very weak. But as the hike pace slow, 75, 50, 25, into a skip and into a pause where we are now, things got better. So the stresses ease up. So that's the big trend that you saw over the past 1 year or so. Stresses are easing. Now, if you want to zoom into a micro time frame, say the past 6 weeks, you notice that things got even better, right? Because it became even clearer that the Fed is more balanced, right? Over the past 1.5 years, it's hawkish. You want to hike rates, you want to slow things down. But now it's a lot more balanced, right? So that is reflected in higher stocks prices and better credit spreads. So that is one big change that's happening. The Fed is no longer generating negative volatility. How about rate pricings, right? Rate pricing can be split into the short end and the front and then the long end at the back. So risk pricing, I've also put in the red line as well as the beige line. These are what the Fed thinks it would do back in June as well as September. And the dotted black line is where the current pricing is. Right? So this swing very widely. And right now we are at the point where the market thinks that rate cuts will come a little bit earlier than what we and the Fed think. And this is a very big change from just 6 weeks ago, where the market was looking at just 2 cuts next year. Right now it's looking at about 4+ cuts, more in line with our view. Now on the longer end, if you're interested in 5-year or 10-year, the chart on the right shows you the 10-year yields, and I've bucketed them into different kind of pricing, right? Anything above, say, 4.5, and we got as high as 5% for a while, that should be pricing in a strong economy, which was the case, right? If you look at the third quarter growth, the US was incredibly strong. But what if growth slows, right? Then we should go into a moderate pricing, which could be anything from 3.8 to 4.5%. And we got there pretty quickly. I guess we'll stay there for a while. And if we go into a deeper slowdown, then we'll see rates below 3.8. But that is not our core scenario, right? So we are slipping from strong growth into moderate growth. In terms of the risk, we think it is, from the risk perspective, is about balance. So soft landing, what does it mean, right? It means the rate shouldn't be so high, and it means that the curve should be a little bit steeper, right? Because why should you be so pessimistic if things are not that bad, right? So then in terms of risk, it is positive. So some of it is playing out as we speak, right? So on the upside, if things get so good on the markets front that it supports the economy, then the rate cuts that the market has been penciling in might not materialize, right? And if that's the case, the outlook for risk is a bit more mixed because rates will be higher. Now, on the downside, we have seen banking crisis worries. We've seen the CRE worries in the US. This could resurface at any time. And the other part is we haven't got the good handle of how and when these high rates will start to bite. It could be with a bigger lag and a bigger impact further down the line. And if that is the case, we should see clearly lower rates from where we are now and much steeper curves because the cuts will be faster and larger in magnitude. Yeah, so that's where we are now. Goldilocks has been playing out for a while, and we still think that is the key scenario. And rates have adjusted as well. Okay, over to Hunting.
Thank you, Eugene. So I'll bring you closer back to home now and what will be in stock for the Singapore economy. So forward, Singapore has 7 key shifts. I have 7 key themes here. But today I'm not going to talk about all 7 of them. I'm going to talk about 5 of them and leave you some room to look at our report, which has a lot more charts. So 2024 will be a year of renewal for the Singapore economy. And why so? Renewal in terms of better growth prospects. Inflation will be bumpy but moderate. And in terms of the leadership transition, it will be an important year of renewal. Monetary policy-wise, room for normalization. So let me bring you through these themes. So firstly, in terms of growth, I think 2024 would see a gradual, yet a fragile external-led recovery. And where have we come from? So let's look at 2023. So 2023, we've seen that the Singapore economy has softened, but achieved a soft landing, where it has basically narrowly avoided technical recession in the first half of 2023. And as we head into the second half of the year, growth started to tick higher in the third quarter of 2023. And we think that that basically marks the turning point for the Singapore economy, and we will see a gradual recovery from here on. And it's not what I'm saying, right? What are businesses saying? And we can look at the right chart here, which points to certain business expectations for external-led sectors. So one of which is very important is the manufacturing sector, which accounts for around 20% of GDP. And we see that what businesses are saying for 3 quarters straight is that they are positive for the outlook over the next 6 months, so going into 2024. And this will be mainly led by the electronics sector, which accounts for the bulk of manufacturing activity in Singapore. With inventory being digested, there's some room for a cyclical pickup. And manufacturing would have positive spillovers into wholesale trade. And we see that businesses are positive for the first time in several quarters. So this is also a good sign in terms of trade-related services. And lastly, the other sector which has been quite weak is the financial services sector due to the rise in interest rates. And here there's some room for a recovery as interest rates peak. Even some room for rate cuts, as mentioned by Tamer, Philip, and Eugene. So financial services would probably have a better year in 2024. So now the other important thing is inflation. And we think 2024 would see a bumpy but eventual moderation in inflation. So inflation has been coming down over 2023, but 2024 will see a pickup in the early part of the year. And these are due to domestic pressures where the GST will be hiked by another 1 percentage point. So if you have not yet buy your big ticket items, now is the Christmas season, so probably you should front load some of these purchases. But anyway, in 2024, you'll see this bump up in inflation. It's quite similar to 2023. But eventually, some of this impact would fade off. And what is the key reason for that? The reason is that imported inflation would still be quite contained. And just now, Philip mentioned about MAS's monetary policy and the strong Sing dollar. That's helping, dampen some of the imported inflation. So food, which I'm sure you all spend quite a lot on, is also a big component of the inflation basket. That's coming down, and imported food prices are actually in year-on-year contraction. So that would translate into, continued moderation in food inflation. And in terms of domestic cost pressures, in terms of wages, wage growth is starting to ease off a bit. So that would also translate into probably slower inflation, at least on the services side of things, looking at discretionary services. So thirdly, the most important thing I'm going to talk about is the 4G leadership transition. And this would be a major transition for the first time probably in 20 years. So in 2024, as Prime Minister Lee mentioned in his November speech, he will be looking to pass on the leadership to the 4G team, led currently by Deputy Prime Minister Lawrence Wong. If all things go well, I'm sure all things will go well. And we expect policy continuity. And, PMD also added in his speech that, DPM Wong has been putting in a lot of effort to try to to eventually take over the helm, and increasingly leading the national agenda. So that would be the Forward Singapore exercise and conversation. And there we see that over this 16-month exercise, the 4G team has engaged with Singaporeans, and in end October basically launched the Forward Singapore report. And here they mention about 7 key shifts to build a more vibrant, inclusive, fair, thriving, resilient, and united Singapore. And essentially trying to refresh some of the social compact and what is being defined as the Singapore dream. So there are 7 key shifts here, ranging all the way to early education, to the elderly, where the population is aging. So a lot of things that is going on here. And this would be the policy priority going forward. So in terms of policies, what would be the path forward? In 2024, I think there will be quite a lot of fiscal prioritization, in the sense that inflation is coming down, but actually inflation coming down just means cost is going up at a slower rate. So your cost of living is still high. And this is something that is hotly debated in Parliament very recently. So that is probably one issue that they'll continue to address. Then the other thing is they also need to consider long-term priorities, which is those that I mentioned just now that was being pointed out in the Forward Singapore report. And here, Singapore tends to run a prudent fiscal position. So in the current 5-year government term, actually, Singapore's fiscal performance has been better than expected. So that's referring to FY 2021 and FY 2022. So it recorded surpluses instead of deficits. And that's because of the strong recovery that we have had. So there's room to provide support in the near term, as well as do some, allocation for, future long-term priorities in Forward Singapore. And lastly, just on monetary policy, just want to reiterate Philip's view about monetary normalization. So we expect the MAS to have some room to reduce the Singapore near policy band slope, sometime probably in the second half of 2024. And this will be in line with the eventual moderation in inflation that I've talked about, and as well as being in line with the Fed's eventual cutting cycle. And in conclusion, Singapore will see a year of renewal in 2024, and let's look forward to it. Thank you.
Thanks, Han-Ting. So after Singapore, we want to move on to Taiwan, another relatively advanced economy in Asia. In Taiwan, our title is Opportunities Amid Uncertainty. I have a chart showing Taiwan's economic cycles in the recent years. As you can see from the chart, in 2020 and 2021, in fact, Taiwan was doing relatively well. It avoided a recession during the pandemic in 2020, and it's also achieved a very strong economic expansion in 2021. But last year and this year, there is some sort of challenge, the stagflation challenge. Because of the Ukraine war, because of the rise in global energy price, we saw inflation in Taiwan rising significantly. On the other hand, because of US monetary policy tightening, global trade recession, Taiwan's economic growth also slowed significantly. Going forward into 2024, we are expecting a better year for Taiwan. GDP growth, we forecast 3.5%. That is higher than 1% this year. And CPI inflation, we also expect it to come down 1.7%, slightly lower compared to 2.3% this year. So basically, the economy will move from stagflation towards Goldilocks. Why do we believe 2024 will be a better year for the Taiwan economy? Very important reason, we believe global semiconductor sector, global electronic sector is on a cyclical recovery. I think both Taimou and Han-Ting, they have mentioned earlier during the presentation. Here we have a chart showing the global semiconductor sales. You can see there are some typical cyclical patterns. Usually 2 to 3 years of upturn and 1 year of downturn. And after that, there will be another 2 to 3 years of upturn. This up and downs, in fact, is due to the investment cycle in the semiconductor industry. For the semiconductor companies, usually they need to spend 2 to 3 years to build the new foundries. So when demand increase in the semiconductor sector, usually the companies, they may not be able to meet the increase in demand immediately. And when they build the new foundries, release the new capacity, the demand probably has already passed a peak. So this kind of supply-demand mismatch is explains why we have this kind of up and downs in the semiconductor sector. The very recent upturn, as you can see from the chart, was actually between 2020 and 2022. That was during the pandemic. The lockdown actually has boosted demand for mainly electronics devices, also boosted demand for semiconductor components. But this year, because of reopening, the pandemic demand disappears, the global semiconductor sector falls into a deep decline. After this whole year of correction, in 2024 and 2025, we should see a new round of expansion. Fundamentally speaking, we also see some important drivers that will come from AI, the new technology adoption. Currently, many cloud services providers, from Google to Microsoft, that investing into AI, they are building, designing their own customized AI chips. And meanwhile, the mobile phone producers, PC producers, they are also pushing for product innovation. They are trying to install AI into the end devices to improve the experience for the end users. So accordingly, we believe the AI-related semiconductor demand will grow very strongly in the coming years. The growth potential will be around 20% per annum between now and 2027. Taiwan will be a major beneficiary of the semiconductor sector recovery. Taiwan is the largest chip foundry base in Asia and also in the global markets. And for the Taiwan economy, semiconductor sector is also a pillar industry. For Taiwan's exports, in fact, around 40% semiconductor exports. And exports also account for around 60-70% of Taiwan GDP. So as you can see, in Taiwan, the trade and manufacturing data, they have already started to improve exports, export orders, manufacturing production. They're almost turning around. Inventory level, in fact, has also come down very significantly. Having talked about opportunity, I also have to mention the uncertainty. The uncertainty will certainly come from the elections. Taiwan will have its presidential election in January 2024. Well, in order to understand the impact of elections on the economy, we have conducted some analysis. We analyzed the movement of major economic indicators 2 quarters before and 2 quarters after presidential elections in the past 20 years. And this covers 6 election periods between 2000 and 2020. Some interesting finding here. One finding, CPI inflation tends to increase after elections. The new governments, after taking office, they have a tendency to reduce energy subsidies, in part to improve public finance position, in part also to encourage the green energy transition. This year, in fact, the government has already raised electricity price by 11% in April this year. And going forward, whether there will be some further electricity price hike, the energy policy reform measures, we think this will be an uncertainty and a risk we need to monitor for 2024 because it will impact our inflation forecast and also the monetary policy forecast. More importantly, we see some capital flow volatility surrounding the Taiwan election periods. The FDI flow, in fact, remained stable before and after elections. But the portfolio capital flows, as you can see, the stock market and bond market flows, there is a high degree of volatility before and after elections. The foreign investors, especially the foreign investors into Taiwan's stock market, in fact, they are very sensitive to the election results. They are worried that the results probably will impact the Taiwan-China relations. This year, there are some similar worries. In fact, China side, they have already initiated a trade investigation against Taiwan since earlier this year, and they will announce the results in January 2024 after the Taiwan elections. So whether China will terminate the free trade agreement with Taiwan, the so-called ECFA agreement with Taiwan, or whether China will also come out with some other kind of economic or political response. I think that is a very important risk we need to monitor for 2024. So basically, for the macroeconomic side, in fact, we are confident about the outlook. We believe there will be a recovery because of the semiconductor sector rebound. But in terms of geopolitics, in fact, we are cautious. There will be a higher degree of uncertainty in the coming 1 year. I think I will pass on to Radhika.
So I'll round up the country part of the discussion, heading into India and Indonesia. And I think one common thread between these two countries and Taiwan is that India and Indonesia are also heading into elections next year. And the point of difference between Taiwan and India and Indonesia is relatively low beta to what's happening globally, in terms of how especially the US and Eurozone, growth is. Of course, Taiwan and some of the other Southeast Asian countries are much more exposed to what's happening in the West. So let me quickly, and I have the privilege of doing two countries relatively fast. So I will give you a larger picture on what's happening in these two economies. Now, India, starting off with India, the narrative around this country has really been very positive, in the past few years. It was much more in the past 2-3 years. Growth has been strong. I think Temur mentioned about the stock market. Certainly, I mean, foreigners have plowed in about $15 billion this year, but the retail investors have actually participated very strongly. So number of demat accounts, for example, is about 100 million this year. So retail investors have come back or come in to the equity markets quite sharply. Now coming back to the macro, growth in the first half of the year was about 7.7% for India, so very strong. For the year, growth looks very close to 7%. Now, this really stands out when you compare. On the right, you can see the other countries where their growth levels are. So India is certainly going to stand out on that front. The next obvious question is what's driving this growth, when the rest of the world seems to be moderating. And I think the place of strength that India is coming from is basically the growth is much investments driven. The government has actually been plowing a lot of money into infrastructure. Now, that begs the question, where are they funding that infrastructure from? Revenues have been good, as you can see in the middle chart. In fact, compared to where the budgeted amounts are, revenues have been doing much better, direct as well as the indirect taxes. And the balance sheets are stronger. The people who are participating, the economic actors, the government, the banking sector, the private sector, they in fact used easy liquidity, low rates during the pandemic to clean the books rather than to build up more debt. So that has certainly helping the growth picture. So that's, I think, one of the reasons why growth has picked up. Consumption is very important for these countries. Consumption is also doing well. But as interest rates remain high, I would personally be a bit more cautious about where consumption is going to go for India in particular. But investments certainly important. And India is heading into an election next year. The most recent election results that came out, which is for the provincial or state elections, actually tell you that there is a higher possibility that political stability will remain in place next year. Very quickly on inflation and rates, and I think this was touched upon in various slides that you saw, especially in the overview slides. Growth has been strong, but India's inflation is also quite exposed to what happens to weather. Weather is bad, rains are poor, food prices go up. So because of that, the rates have actually been very, very high. So you can see the black line. It's at about 6.5% in terms of where its rates are. So if growth is looking good, inflation is high, there is no reason for the central bank to cut rates. And I think that's the moot point on the policy side. So if Fed cuts rate, we could see the RBI, which is the Indian central bank, also lower rates, but not as aggressively as the Fed does. So, and of course, it's a happy place to be in for the central bank if the growth is generally doing better. The last bit on the exciting part of the story, and I think this is where you must have heard if you talk about supply chain reconfiguration, fragmentation, that India is finding its mojo finally, right? There's been a long-standing need for India has been trying to attract investments, but it's found relative success more recently. And I think it's a pull and push thing globally as well. The investors have been looking for a destination which offers a big market, consumers, also ability to re-export. And that's where we have seen, the benefits play out. Meaning India's manufactured exports are going up because of pharma, because of electronics, because of engineering goods. And India is also exporting much more to the US. Of course, in terms of quantum, I think China and Brazil and all are much, much higher. But you can see that slowly the share of US purchases from India have also been going up. So these are just two signs to show you that, all the talk that you hear about India's pushing its manufacturing footprint is actually bearing fruit. Let me quickly shift gears to Indonesia, closer to the region. And here too, Indonesia has actually presented a fairly positive outlook. Now, what has really played into Indonesia's hands actually this year has been, I'll just go to this and probably I'll come back. What has really played into Indonesia's benefits is basically what's happened to commodity prices. It's very exposed to what happens to coal, what happens to copper, what happens to palm oil. So the last 2 years, actually, the country has seen exports do very well. And the other big thing that has happened is foreign investments into nickel, into electric vehicle. That space has gone up sharply. And you can see the black line on the right. Actually, it's completely and fully concentrated on the base metal space, which is the metals, not the larger manufacturing piece, but much more on the base metal space. So that FDI has helped. It's gone to the provinces. It's helped to generate a good investment growth, and that's behind what's happening on the growth front as well. And at the same time, we had done an interesting piece. If any of you are interested, please do reach out to us or your RMs on what's happening to this China Plus One strategy. You would have heard a lot about money being put into ASEAN. We explored, is China investing in this region? Is the US investing in this region? Which other country is investing? So we'd gone into depth into that. And one of the takeaways we had is that China is actually investing into ASEAN quite strongly and quite actively. So that just tells you, where the money has gone. Some parts to Singapore, and obviously a lot of money has gone into Indonesia as well. And that money that's gone into Indonesia is concentrated really in the smelters and base metals space. And lastly, a passing word on the elections. India holds its elections mid of next year. Indonesia holds its elections on Valentine's Day. So first half of the year, you're going to, if any of you are Indonesia watchers, you'll hear a lot about the election cycle. It looks very likely like that, there's going to be a runoff, meaning that no single candidate will be able to get over 50%. So there'll be a re-election in about June, July. So good part of the year. And October, they take office. So good part of the year will be about elections. And that will certainly determine where growth goes. So we do hope that when we do publish our annual report on these countries, you can look into it for further details. So now we are on to the last section of today's chat, which is Wei Liang will dwell into the credit piece. Thank you.
Right, I'm Wei Liang. So thank you for your patience. I'm the last speaker for the day. I'll wrap it up in 6 minutes, what our outlook for credit markets are going to 2024. So first up, US credit. So we are not so bullish on US credit, although US credit has done well. Investment grade US credit has turned 5%, around 5%. High yield has returned around 10%. Going to 2024, I think we're going to see some headwinds. The first is obviously from higher rates. It takes time for rates to be passed on as higher interest payments. It takes time for this higher rates to actually hurt companies' bottom line. Based on our estimates, we think it takes about 3 to 5 quarters for rates to be fully transmitted into the borrowing costs of companies. So what does that mean? So if even the Fed has finished hiking rates in July, we could see only a very delayed effect on companies' profitability, with a maximum impact being felt perhaps in Q2, Q3 of this year. So we are not past the worst in terms of the interest rate hike headwinds. The second point I want to make is on the fact that profitability and leverage levels in US credit, they have bit more. We see. Thanks. Oh no, this is working. So we think default rates is going to climb a bit more towards the long run 10-year trend around 3.9%. If you exclude the SVB failure, actually defaults have been running way below the 10-year trend. But we think that given the fact that it takes time for interest rates to hit the balance sheets, to hit the profitability of companies, this is definitely going to be rising into 2024. And if you look at where we are on the US high yield of credit spreads, they are around about 360, 370 basis. Not quite enough, I would say, to compensate for, I think, continued rise in the US default rate towards about 3.9% next year. But relatively speaking, we think Asian credit could do better. Although we know Asian credit has actually been underperforming US credit this year. Why is that? So the main reason, if you look at the issuance, gross issuance activity for 2022 and 2023, Asian gross issuance have fallen by more than half in the last 2 years compared to the previous year. So from that perspective, there's just not really a lot of bonds out there. So when inflows start returning back to Asia, that's going to trigger a bit more of a price action. It's likely to lead to a much more substantive narrowing in credit spreads. And if you look at why Asian credit issuance have fallen, this chart says very clearly why. It's because of China. China has seen net issuance fallen dramatically since the second half of 2022. No prizes for guessing what's the reason. The reason is because there's a lot of stress in Chinese credit markets. Chinese real estate developers have faced very severe liquidity strains. The sales have been falling. And because they're so leveraged, they couldn't really go back to markets to tap financing. So that led to a bit of a defaults across some of the larger developers. Obviously leads to questions over banks' asset quality. It leads to question over the economy. It leads to even local government financing vehicles. So what are the LGFVs? They are essentially provincial local governments own enterprises. They are in charge of infrastructure investment. They are a bit of a legacy from the past where local governments cannot tap bond markets, so they depend on LGFVs. So because land sales have fallen, LGFV credit worthiness is also now under question. But the important thing to recognize over here is that China is not like any Western economy. There's a very important central actor over here, which is the Chinese government. They're very much focused on stability. That's the watchword for the government. We've seen them taking very strong actions. For instance, on the RMB, we were, a very lonely voice in the market out there saying that PBOC will be safeguarding RMB stability, and indeed they have. So more recently on the housing market, they have been lowering down payments. They have been asking banks to lower mortgage rates. On LGFV's front, they have allowed some of the local governments to tap special financing bonds to essentially lend to the LGFV. So if in effect, that's bringing the LGFV liabilities back onto the local government balance sheets. So it's more positive on that front in terms of relieving refinancing pressures. Central government has also taken some steps in terms of issuing bonds to help support provincial government. So there's some degree of burden sharing. By no means does that mean the crisis is over, but we think quite likely credit risks in LGFVs, they're not as bad as what markets are thinking. There's quite a lot of doom-mongering in Bloomberg headlines. And if you just look at the headlines, it's very hard for you to imagine that actually Chinese default rates are actually much lower than US default rates this year. Just look at the gray bar over here. Almost 99% of all of these defaults is due to Chinese real estate. So virtually every other sector in China is doing well. There's some strains here and there, but by no means does that mean that we're going to see a credit crisis in the rest of China. And LGFV debt is really a large proportion of it is issued by the more prosperous eastern and central provinces. A very small proportion are issued by riskier provinces. So that means that spillovers on contagion from any LGFV issues likely to be very limited. So what does that leave us? So we think that perhaps the risks, the worst is over for China credit X or Asia credit X real estate. We want to look at some of the peripheral sectors that could potentially benefit from improvement in sentiment. And here we think Hong Kong real estate might be one sector. They are, of course, a bit exposed to China real estate. But the fact is that most of them are actually invested in areas where it's mostly tier 1 cities. They don't have a lot of problems in terms of oversupply in those housing markets. A second reason, if you look at investment grade, if you look at the best rated Chinese developers versus the worst rated Hong Kong developers, there's still a gulf in terms of the leverage. So the leverage on the Hong Kong side is nowhere close to what we've seen in China. So probably we won't see the same kind of issues for Hong Kong developers. And so with that, I'll end and pass this back to Timer.
Thank you, Welling. Don't go because we have some questions from the audience. And the first question, I'm going to put it on the screen now. It's for you, Welling. What's your take on reports that NPLs are rising for China's major banks?
Right, no doubt asset quality is deteriorating for Chinese banks, right? Because the economy is not doing as well. But the important thing to realize is that Chinese banks are very limited exposure to real estate. So there are macro-prudential measures to curb the amount of loan exposures banks can have vis-a-vis developers. There are also very strong measures in terms of high down payment rates for home buyers when they take mortgages with banks. So more likely than not, the banks will be relatively insulated given the high collateral buffers of these mortgages, as well as the fact that they have very small, rather insignificant exposure to real estate developers. So far, the banks have been doing okay. We continue to expect that to be the case.
Thank you very much, William. If you may pass the mic to Mo, because Mo, questions on, sorry, that's not the question, sorry. Let me get that out of the way. There's a question for you.
China
There we
has no
go.
question.
Do you see more support for China property, and what is your base case for the sector? So you've talked a lot about it, but I think the main issue is that I think the word is expect. There's a risk of a domino effect to the sector. So we know that broadly speaking, we're sort of mild rebound and mild soft landing, but what about the bear case scenario?
I think, for China, like in 2024, or say the next 5 years, they will continue to support, the property sector, certainly, especially, for the household side, they will continue to support them to re-leverage up. But, one question for us, one example is like people will ask, say, for the young people in Shenzhen, they ask them, when is the turning point for you to buy a property? Like, then they say, if you give me 1 million RMB, I will think about it. Because they don't have the down payment. So, currently, they don't really have cash to do so. So, in terms of support, for the developers, certainly, to stabilize their current leverage level, help them to repay the interest, but most important, to help them to finish their finished projects. The government will really allocate more resources, to try to help. But, for the domino effect, that is something I think after 2008, everybody's talking about China hard landing. So whenever, property has a hard landing, China hard landing, global hard landing, but by the end of the day, because it's only the deleveraging for the developer sector, but not the household. So we don't think it will really spill over. But on the other hand, you see after 3 years, after the COVID lockdown, you see the consumption after the opening up. It's not strong rebound, but it's coming back, right? If you go to Shenzhen, you can take a look at the Sam's Club and also to be opened, the Costco. It's jammed. Many people start to travel. So this is something I think consumption will start to recover, but also investment for other sectors, manufacturing, high-end manufacturing. So for innovation sector, auto, etc., they are continue to rebound to counter all the slowdown from the property sector.
All right, well, one more question. People are skeptical. So the question is, you mentioned the need for job creation. What's your take on youth unemployment, and what's your view on the strategy to tackle this?
Yeah, many people ask me this question. So I think, there are some things we need to consider. For China's job market, current slowdown is both structural and cyclical. So, for especially for the youth, after June, the report is 21.3%. Then people say, hey, you stopped. That's why people even taking a microscope to try to, look into that. So here, the thing, in terms of structural, we know in the past 3-5 years what has happened for the sectors. Education sector, before it has a lot of teachers, they are like immediately, unhired. Then you see for the financial sector, there's anti-corruption going on. So many people also, getting no jobs. Then, for the sectors such as, financial, education, manufacturing sector as well, right? So global slowdown here, people moving out of China, there is also like a slowdown. Service sector, because of the COVID lockdown, also like is slowing down. So there's a structural change here. But the thing is, what the government has done to really boost it, if you really see the number for China, every year the government consistently in the past 10 years creating 11 million jobs. But every year now, the graduates, the undergraduate graduates is also 11 million more, 11.5 million. So it's not like, all these creations for the undergraduates. So that's why you see the job, the youth employment rate is like, 16, for the age to 16 to 24 is like, it's not only like, 21% what they reported, it should be close to 30%. Now the things what the government has done. So one thing what the government has done to create 1 million internships with the government subsidy, for them to really do the internships. And also what the government do is, for the public sector, like, the hospitals and also the education, the schools, they ask, they can absorb all those, fresh, graduates. So like, the shorten their probation period, they can just go on as doctors. And also China has rural area. China has the northwestern and tip of areas. They encourage them to go. If you go there, you try to develop, we will give you subsidy. This is something the government has to do. But the thing is, for China, if you really see, where absorb most of the jobs is the private sector. It's not, SOE. It's not, the public sector. It's private sector. It's over 90%. So this is where, because private sector now under, the economic slowdown, they wouldn't hire. This is something, when economy is rebound, softly rebounding, also into next year, if like kind of starting to normalizing, we can see more hires coming.
Thank you very much, Mo. The key views that I have sort of talked about today, or the key views that Eugene, Philip, William, we've talked about, they're not that different from consensus. By and large, the consensus is sort of expecting soft landing, rate cuts next year, and so on. We're, of course, cognizant of the risks around that forecast. The area where we are a bit differentiated is actually what Mo is talking about, because by and large, most people that we meet in the client world or in the policymaker room, very skeptical about China's outlook. So this is where I think the granularity with which Mo is sort of attacking the issue and saying that whether it is job creation or the property market or the stimulus measures that the authorities have in mind, make us feel that soft landing, soft rebounding, and soft risk is a central scenario. I think that's the big differentiating one. She's been with us for just 3 weeks. She's going out on a limb and giving you a differentiated call. So we'll take stock a year from now.
Okay.
Thank you very much, Mo. So Steve Jobs used to do this, right? One more thing at the end of his presentation. So what is our one more thing? Several of us over the last 1 year have worked on what we call a macro insights portal, where we have a lot of JavaScript-based visualization. If you scan that QR code, you can see a lot of work on FX, on rates, on GDP nowcasting, on risk assessment that we are now putting on our website. So this is our early preview. We haven't formally rolled it out to the whole world. You're one of the first people to see it. It's been on a sort of soft launch basis for a long time. So check this out. There are a whole bunch of other things that we do. In case you don't know, a few months ago, we started a tactical trade monitor. So every Wednesday, we publish our favorite trades, and we make it verifiable and trackable, so you can actually see whether our trades are making money or not. So that's one thing that we're very proud of, and we're doing it. Every month, we do a live stream, events like this, and our US dollar credit coverage under Eugene's leadership. We're going to have 4 strategists doing US dollar credit, 1 doing Sing dollar credit. So a lot more names in our credit analysis that we will do in combination and collaboration with our private bank. So watch out for that. And final thing is Macro Insights Portal. So we started a little late. We're ending just a couple of minutes late. Thank you very much, everybody. And thanks to my wonderful team for their presentations. And enjoy the snacks outside. Great to have you all.